What's up, everybody? All right, 20 more NMLS style mortgage loan originator exam style questions to get you through that exam. Let's go. Question number 1. Under HOEPA, the Home Ownership and Equity Protection Act, which of the following is a high-cost loan trigger? Letter A, the APR exceeds the APOR, the average prime offer rate, by 1.5% for a first lien mortgage. Letter B, the borrower has a DTI ratio exceeding 50%. Letter C, the loan has prepayment penalties beyond 36 months. Letter D, the borrower's FICO score is below 600. And the answer? Letter C, the loan has a prepayment penalty beyond 36 months. All right, so you want to know the differences between a high-cost loan and a higher-priced loan. And they're both inside of the Truth in Lending Act. So there's a law inside of a law called HOEPA, which stands for the Home Ownership Equity Protection Act. And those are known as Section 32 loans. If you look up Section 32 of TILA, you'll find this referenced law there. Now, what it addresses is high-cost loans. And so the question is asking us, under HOEPA, the Home Ownership and Equity Protection Act, which directly addresses high-cost loans, which of the following is a high-cost loan trigger? Now, letter A, the APR exceeds the APOR by 1.5%. That's for a higher priced loan. That's Section 35. That's a little bit different. You're going to learn about these, and a lot of students get confused about these two, so you do want to check your materials for the answers here. The borrower has a DTI exceeding 50%. That they're trying to bait you into thinking about like qualified mortgages and that kind of a thing. The borrower's FICO score is below 600. That has nothing to do with a high-cost loan trigger, but the prepayment penalty. So if a loan product has a prepayment penalty that exceeds 36 months, then it would technically qualify as a trigger for a high-cost loan. Question number 2. Anthony, a 17-year-old applicant, applies for a loan, but the creditor denies his application based on his age. Has the creditor violated the Equal Credit Opportunity Act? Letter A, yes, because ECOA prohibits discrimination based on age under all circumstances. Letter B, yes, because the creditor cannot consider an applicant's age when making lending decisions. Letter C, no, because the ECOA only protects applicants based on age if the applicant is of legal age to enter into a contract. Letter D, no, because age is not a protected class under the ECOA. And the answer? Letter C, no, because the ECOA only protects applicants based on age, subject to the legal age of the applicant. So this is classic. You many times will see questions like this. They want you to know, number one, that ECOA does protect age as a protected class. So it's race, color, religion, national origin, sex, age, marital status, and the receipt of public assistance. So there are 8 total protected classes, 5 of which are the same as the Fair Housing Act. But you want to know that if somebody is not of legal age to enter into a contract, then it is not a violation because a creditor denies you because you're too young. Question number 3. What does the acronym SAFE in the SAFE Act stand for? Letter A, Secure and Fair Enforcement Act. Letter B, Secure and Federal Enforcement Act. Letter C, State and Federal Enforcement Act. Letter D, Safe and Fair Examination Act. And the answer? Letter A, the Secure and Fair Enforcement Act. So, the SAFE Act is the reason why all of y'all are studying for this exam. It set the standards for state licensed entities to require standards, educational standards, examination standards, and the reason why you're taking these courses and studying for this exam is because of the SAFE Act, the Secure and Fair Enforcement Act. Other things that you want to remember here are the penalties for violating the SAFE Act. Question number 4. Where do mortgage bankers get the funds to originate mortgages? Letter A, by using their own capital and credit lines, then selling loans to investors. Letter B, by collecting monthly payments from borrowers and reinvesting the funds. Letter C, by pooling money from depositors like traditional banks. Letter D, by directly issuing government-backed loans without third-party involvement. And the answer? Letter A, by using their own capital and credit lines, then selling loans off to investors. So how the secondary and the primary mortgage markets work are things that you ought to know the basic mechanics of. So you want to know, how does the primary mortgage market, who makes up the primary mortgage market, like mortgage brokers are in the primary market versus the secondary, who the secondary mortgage market players are, definitely going to want to know those, and kind of understanding the flow of like what a warehousing line of credit typically looks like, definitionally. And this is something that you definitely want to know for that exam, I would suspect. Question number 5. The Fair Credit Reporting Act, the FCRA, is also known as letter A, Regulation X, letter B, Regulation O, letter C, Regulation V, letter D, Regulation Z. And the answer? Letter C, Regulation V. All right, so you want to know some of these letters like the Reg V, Reg X, Reg O, Reg Z. Reg Z, one of those popular ones, is going to be the Truth in Lending Act. Regulation V, a great way to remember this one for the Fair Credit Reporting Act. Think of credit. Fair Credit Reporting Act, think of a credit card. A Visa is a credit card, a type of credit card. So therefore, Regulation V, V for Visa, you should remember that connected to the Fair Credit Reporting Act. And don't forget, inside of the belly of the FCRA lives the FACT Act. Question number 6. How does the U.S. Treasury Index relate to mortgage lending? Letter A, it is used as a benchmark to determine interest rates for adjustable rate mortgages. Letter B, it sets the maximum interest rate lenders can charge on all mortgages. Letter C, it is used to determine the minimum down payment required for government-backed loans. Letter D, it is used to determine the maximum interest rate only for government-backed loans. And the answer? Letter A, it is used as a benchmark to determine interest rates for adjustable rate mortgages. So indexes are the adjustment vehicle that an adjustable rate mortgage looks to. Remember, there's two components. The primary components are the index plus the margin. You are definitely going to want to know how to calculate adjustable rate mortgages and their features like conversion options and the benchmark times where they adjust, the adjustment periods, and so on. Hybrids, which are like 5-1 arms, 7-1 arms, 10-1 arms, those kinds of things. You want to know a little bit about all those. But you definitely want to know that the U.S. Treasury Index is for sure an index that we use to remember or measure where the adjustment of this mortgage is going. Question number 7. What is the purpose of the Home Mortgage Disclosure Act, HMDA? Letter A, to ensure lenders are providing loans based on the borrower's credit score. Letter B, to monitor and track home loan applications and denials to ensure equal access to credit. Letter C, to provide a standardized method for calculating the interest rate for mortgage loans. Letter D, to prevent predatory lending by restricting loan terms. And the answer? Letter B, to monitor and track home loan applications and denials to ensure equal access to credit. So the Home Mortgage Disclosure Act is a law that is looking for data, and the data is tracked and monitored, and the majority of the data is collected through the loan application registry, which is filed with the various enforcement divisions of each state. And so what happens is the regulators are able to track if people are being discriminated against. So a term that goes hand in hand with HMDA is redlining. You want to know redlining as a prohibited practice, its definition, not making a loan in an area for reasons other than economic qualification. And you want to be able to tie that to the Home Mortgage Disclosure Act, or Regulation C, also known as HMDA. Question number 8. A lender runs an advertisement stating, get a 30-year mortgage for just $1,200 per month. Under the Truth in Lending Act, what additional information must the lender include? Letter A, the borrower's required credit score and debt-to-income ratio. Letter B, the lender's contact information and NMLS ID number. Letter C, the loan's APR, term, and down payment requirements. Letter D, the borrower's maximum loan amount and closing cost estimates. And the answer? Letter C, the loan's APR, terms, and down payment requirements. At the very least, you're looking for, with triggering terms, you'll study these in your books and materials that you're taking these courses in. You want to know that the Truth in Lending Act, one of the things that it requires is truthfulness in its advertising. And that requires, if I'm going to advertise a rate or a payment, then the APR must always also be included in the advertisement. As a matter of fact, the only opposite, and I would suspect this would be a potential great question, is the only thing that can stand alone is the APR. So if you get the reverse of a question like this saying that, hey, listen, this is, an advertisement, get a 30-year mortgage at 3.167 APR, then under the Truth in Lending Act, there is no additional items needed if the APR is being disclosed. But that's the opposite of what this question is looking for. And therefore, if I were looking at this, I'd be looking for APR in the answer key, and letter C is your answer. Question number 9. Under RESPA, how much can a loan servicer require a borrower to keep in an escrow account as a cushion? Letter A, 1 month of escrow payments. Letter B, 2 months of escrow payments. Letter C, 3 months of escrow payments. Letter D, 6 months of escrow payments. And the answer? Letter B, 2 months of escrow payments. So many times under RESPA, it's going to be 2 months plus $50 is what the account can have, no more than. If there's an overage of that, annual escrow audits and statements will require the lender per RESPA to credit the borrower back a check if there's an overage. So they're allowed to keep up to 2 months plus 1 month's current. Typically, that's what it is. But in this question, the way it's framed is under RESPA, how much can a loan servicer require a borrower to keep? It's 2 months. And then if you read the statute further, it's plus 1 month current plus $50. So I'm just giving you the full breakdown. But in this question, the go-to answer, the most correct answer, I would say, is going to be letter B. It's not going to be 3 months. It's going to be 2 months of escrow payments because that's how the statute is written. Question number 10. Which unethical lending practice involves a lender convincing homeowners to refinance repeatedly to generate excessive fees? Letter A, property skimming. Letter B, loan flipping. Letter C, equity stripping. Letter D, reverse redlining. And the answer? Letter B, loan flipping. So you want to know these different types of fraud and predatory lending practices. And so property skimming is an actual one, loan flipping is one, equity stripping, and reverse redlining, probably less so. Redlining, pretty sure you're going to see, like tied into HMDA. So you want to know these, but loan flipping is a classic one. And this one, many times people pick equity stripping when they look at this one. So I just want to point that out so that you get this one right. This is a classic one that I would definitely say you want to know. Question number 11. Which of the following establishes provisions for requesting cancellation and termination of private mortgage insurance? Letter A, the Homeowners Protection Act. Letter B, the Truth in Lending Act. Letter C, the Real Estate Settlement Procedures Act. Letter D, the Fair Housing Act. And the answer? Letter A, the Homeowners Protection Act. The HPA, as they sometimes refer to it, deals with the cancellation of private mortgage insurance. Other things about PMI you want to know, basically at what loan to value, will you require PMI if you put down less than 20%? When is automatic cancellation versus when you can petition the bank? One is 78% loan to value, also reflected as 22% equity. Remember that. And you also want to know that the HPA calls for the auto termination. Now, PMI is canceled, but MIP, which is mortgage insurance for FHA loans, never cancels. Question number 12. Which entity enforces the TILA-RESPA Integrated Disclosure Rule? Letter A, the Federal Trade Commission. Letter B, the Consumer Financial Protection Bureau. Letter C, the Department of Housing and Urban Development. Letter D, the Federal Reserve. And the answer? Letter B, the Consumer Financial Protection Bureau. Okay, so currently the CFPB is the enforcer of the TILA-RESPA Integrated Disclosure Rule. It is to be seen in the future what is going to happen as of the time we're recording this. However, currently this is what is going to be tested on as you are watching it. Always go to the NMLS site, the main site, and look up any educational or exam testing notices. It is there where they will update you as to what you need to know up to the minute versus not, and what is being implemented onto these exams. But for this question, I'm going to run it like it's the right answer, but I want you to remember that things are changing in the, in sort of with the CFPB. And with that in mind, I want you to know that currently they're the enforcer, but that might change. Question number 13. Under the Truth in Lending Act, TILA, what must the lender disclose to the borrower within 3 business days of receiving a loan application? Letter A, the good faith estimate and truth in lending disclosure. Letter B, the truth in lending disclosure only. Letter C, appraisal fee and closing costs. Letter D, loan estimate. And the answer is letter D, the loan estimate. So the TILA-RESPA Integrated Disclosure Rule, or the TRID rule, sort of is this marriage of disclosures between RESPA and TILA. However, TILA is what is now requiring the loan estimate to be delivered to the consumer within 3 business days of receiving a loan application. You want to definitely know what is a loan application for this exam, and you want to know the requirements for disclosure, and those documents, the loan estimate and closing disclosure, are definitely going to be tested, I would suspect, on an exam like this. Question number 14. What is the main purpose of mortgage-backed securities, MBS? Letter A, to allow lenders to offer lower interest rates by bundling mortgages and selling them to investors. Letter B, to provide direct funding for new home construction projects. Letter C, to ensure mortgages against default risk. Letter D, to prevent homeowners from defaulting on their loans. And the answer? Letter A, to allow lenders to offer lower interest rates by bundling mortgages and selling them off to investors. So, understanding secondary mortgage market operations fundamentally is pretty important. I would say you're going to see something like this, something similar. Again, I don't have a copy of your exam, so that's not how it is. I just have a really good targeting system to understand this material and what somebody might ask you. And I would suspect that you're going to be required to know at least the basic function and who is Fannie Mae, Freddie Mac, Ginnie Mae, what they do, and to allow lenders to offer lower interest rates by building mortgages, bundling them and selling them off into like these slices called tranches is definitely what you want to know. And mortgage-backed securities is what they create. Question number 15. Which of the following would be least likely to be considered mortgage fraud? Letter A, providing false information about income on a loan application. Letter B, falsifying documents to inflate the value of a property. Letter C, using a straw buyer to conceal the true identity of the borrower. Letter D, applying for a mortgage with a spouse because they have a higher credit score. And the answer? Letter D, applying for a mortgage with a spouse because they have a higher credit score. So the question, again, these like negatives are really tricky. You need to read them carefully. The question is basically saying which one of these four is probably not mortgage fraud. Therefore, the other three are going to be fraudulent. So you're looking for the one that's least likely to be mortgage fraud is what they're saying here. And the first three, A, B, and C, are very straight up mortgage fraud. Using straw buyers, you want to know what that phrase is. Falsifying documents, oh yeah, that's fraud. And then providing false information purposefully, yeah, that's also fraud. So D is the correct answer. Question number 16. According to the Equal Credit Opportunity Act, the ECOA, at what age is a potential borrower considered elderly? Letter A, 60. Letter B, 62. Letter C, 65. Letter D, 67. And the answer? Letter B, 62. Man, I hate this word, elderly. But the truth is, you want to know in terms of Equal Credit Opportunity Act, and also you're going to see potentially a loan product called the home mortgage, the reverse mortgage, mortgage opportunity for the reverse. And the reverse mortgage is something that you're definitely going to see potentially as a product on the exam. You want to know just a wee bit about that thing and what the qualifying age is for a reverse. And then also knowing that 62 is the age that you're considered elderly. Question number 18. For a VA loan, what document is issued to inform the borrower and lender of the appraised value of the property? Letter A, appraisal report. Letter B, comparative market analysis. Letter C, notice of value. Letter D, assessment notice. And the answer? Letter C, a notice of value, also known as an NOV. So for VA loans, you need to know a couple of pieces about them. Number one, you want to know about this notice of value. It's the document issued to inform a borrower and a lender of the appraised value of a property. So that's one of the documents that you see. Then you see things like the certificate of eligibility. You want to know a little bit about the fact that there's no mortgage insurance for a VA loan. So you want to know some of the things, the basic parts of VA and FHA and USDA loans, as those will be probably covered. They are definitely on the exam outlines for this exam. Question number 19. What does PITI stand for in relation to loan payments? Letter A, principal, interest, taxes, and insurance. Letter B, principal, interest, taxes, and investments. Letter C, property, interest, taxes, and income. Letter D, payment, insurance, title, and interest. And the answer? Letter A, principal, interest, taxes, and insurance. This is pretty straightforward, but you definitely are going to want to know what PITI stands for. Question number 20. What are the four essential elements of a promissory note? Letter A, property description, loan term, APR, and signature. Letter B, loan amount, interest rate, repayment terms, and borrower's signature. Letter C, credit score, down payment, collateral, and insurance requirements. Letter D, mortgage insurance, lender fees, prepayment penalties, and credit history. And the answer? Letter B, loan amount, interest rate, repayment terms, and borrower's signature. All right. You definitely want to know a little bit about a promissory note and a mortgage. These are definitely terms that you are going to see on a mortgage finance exam. So that process and the documents involved in what a mortgage transaction is are pretty important. You also want to know these basic elements of a promissory note. And that wraps up 20 pretty solid questions for the NMLS Mortgage Loan Originators exam. I hope you found these helpful. Remember, focus on some of the key terms, focus on some of the elements. You definitely want to know your federal laws. You definitely want to know protected classes. You definitely want to know about how things work. You want to know secondary mortgage operations, what a loan application is, and many other items. Good luck with your studies. Good luck on your exams. You guys are doing phenomenal. Thank you so much for joining us and subscribing to the channel. If you haven't, please consider doing so. We look forward to our next training. We'll see you soon.